Happy Saturday, happy Easter, Good Friday. I hope everyone is doing wonderfully and enjoying this beautiful weather. Uh, I'm so glad to have you. We had a short week last week. Yesterday was Good Friday, although it's not a holiday, but the stock markets were closed, although the futures markets are open up to 10:15 West Coast time. And even the currency markets were opened a little later. But majority of, again, activities were really either shut down or slowed down. So there was not a lot going on. But yet, because it was not a national holiday, the government was open and we did have some economic reports. So as always, we will look at our the economy, what happened, what is coming up, the markets, a few things about emerging markets, and a couple of lessons of the week, the trades, and the screen of the week. So, in a nutshell, what I want to look at this coming week is a reflection of the non-farm payroll, which happened on Friday. How would that affect not only the markets, mainly the interest rates, and what the Fed's decision will be on upcoming May 3rd. So we will do a little analysis on that. This coming week, I want obviously pay attention. We will have the CPI and the PPI, and on Friday we'll have retail sales. So two kind of different things, look at the inflation, but also look at the consumer behavior. And here we go. This on Monday, we will have a couple of earnings, but the big earnings are starting on Friday morning, and it's the financials, the banks. So the big banks, and this is really important, more important than before. Of course, we had the what has happened March event, with the Silicon Valley Bank, with the Credit Suisse. So we are very much interested in seeing what, for instance, Jamie Dimon has to say, and with we've got the JP Morgan, and then what the banks like Citibank and Wells Fargo, what are some of their outlook. So that's very important. And also, as I mentioned, we want to pay attention to the Fed rates, the expectation of what's going to happen in May and going forward, June, July. And we will look at that in our lesson of the week. One thing I want to pay attention, we've talked about these, I've talked about algos, and as far as what is some pivotal points, some zones that there's a lot of activities happen. And we've been really range bound. If we look back the last few months, 3,800 to 4,200, there has been this magnet right in the middle, about 3,900, 3,930. It's like things go there and then bounce back. And about 4,100 to 4,106 is another one that algos pay attention. And the top part is about 42 to 4,208. So that area also. So it seems like there is this magnet going there, and once we break down, we go to the next zone. So that's from the algos, what they're behaving. So as far as economy, as I mentioned last week, we had a few things happening, and the biggest one obviously was the non-farm payroll. And with the non-farm payroll, important thing was that the numbers came pretty much similar what was the expectation. Now, prior month, for the month of February, we had 326,000. This time it came at 236,000. So it's about 90,000 less than last month, but still pretty strong. It was what Wall Street was expected. But the important thing was the unemployment rate actually went from 3.6 to 3.5%. Now, the average hourly earnings stayed at 0.3%, but it is year over year on annualized basis. When you look at it, is at 4.2%, which is better than 4.3% we had last month. So those are actually music to the ears of Fed. So obviously Fed wants to slow down the earnings side of the thing. So that was helpful. And we will look at the markets, why the market reacted the way it reacted. but these numbers are still strong. And we had for the last month, there was actually added, the numbers were revised upward. One thing that you want to pay attention as far as last week, what happened is that from the manufacturing part of the when we look at the ISM numbers and the manufacturing index, it actually came on Monday and it was at 46.3. The expectation was 47.5. Now, I believe this was a 6 or 7 month in a row that we've been under 50, and under 50 is contraction. So based on that, that slowdown had started many months ago, and it still continues, and it was a little bigger surprise than we expected. So that's one thing it tells us from the manufacturing side. There has been really continuation of the slowdown. As far as the non-manufacturing service, which was, again, a surprise to the downside, but we're still above the 50. So we are not in a danger zone in that way of a slowdown, not in the contraction, but it is, the momentum is downward. So next week, as I mentioned on our outline, you want to pay attention on Wednesday to our CPI numbers, which obviously the Fed is going to pay attention. On Thursday, we will have our PPI numbers and the core. And then on Friday, we'll have the retail sales. So be aware of that if you're going to do any trades. As far as going back to just a little bit about, again, the job market, as I had mentioned, we did go, that we had the 236,000, expectation was 238,000. Now, the total job growth was the lowest monthly gain since December 2020. So just keep that in mind. But unemployment rate dropped to 3.5%. And as I mentioned, we are at 4.2%. Now, most of the jobs in March were added in, and this has been a pattern in leisure and hospitality. Remember, the movement has gone from manufacturing to the service in a sense. So there's more in the service arena, leisure, hospitality, restaurants and bars, for instance, the government, the professional and business services, and healthcare. So now the retail industry lost 15,000 jobs. So with that in mind, I want to show you this chart, which it shows the trend, what is happening as far as we are looking at still strong employment, but skilled versus unskilled jobs, the strength in employment has come from mostly on a lower earning side of things. So the restaurants are still hiring, for instance, the hotels are hiring, but that comes mostly from the lower earnings and more of an unskilled. So we want to differentiate that. Again, the flattening continues. We're going to look at the 5-year actually chart, but a 5-year note, but you can see the continuation. This is as of Thursday of the inverted yield curve, and that doesn't bode well as far as economic growth goes. So let's look at the sentiment. We've been on this fear zone with the AAI sentiment. We've been at 20, 22.5 for weeks. And all of a sudden, on Wednesday, what happened? We are jumped to 33.3, which is still under historical average, but it is more closer to norm. And our bearish side moved down to 35%, which is still above 31, but it's much better than the 48 and 45, 46 that we were in the past few weeks. So there is a little more positive sentiment, which reflects in that CNN fear and greed. We were a month ago, we were neutral. A week ago, we were at 60, and now we're at 56. So we have moved from, actually, we were a few weeks ago, we were actually in extreme fear, moved to fear, and now it's getting overheated. So just because of obviously the rates have dropped so much. There is the when we look at the technology stocks had done very well. You look at the few stocks, so there has been a little better feeling, and we will discuss it in our lesson of the week. Few historical, and I will look at the seasonality as always. So what kind of a week did we have? We had, again, a shortened week. It was a 4-day week as far as the cash concerned. Remember, even Thursday, my God, the volume was low. There was not really a lot going on. So people want to, take their vacation. A lot of places, spring break for high school and schools, young and high school students. So there was not tons of volume. So when we look at S&P, and we will look at an expected move, S&P was basically flat. It was down 0.1%, although the futures were up a little, but the S&P cash was flat. And then the Dow Jones was up actually 0.6, and NASDAQ actually had corrected and it was down about 1.1%. So as a whole, we still look at NASDAQ, we see that we are still up 17.3% from January 5th. We were over 20. Again, we were in a bull market. Now we are in a close to bullish part, 17 point, and we only down 1.1% from March 31st high. And when we look at the whole market for the week, we were down 0.51 of 0.5%. And a lot of markets, basically flat. The large cap value was down only 0.18. But we go back, we emphasize it's small cap growth and value still struggling. They were down almost 3% on the growth, 2.86. The small cap as a whole, they were down 2.67. So what does the charts tell us? Again, there was not a lot of activity when we look at the S&P futures. When we look at the Fibonacci, you can see that we had discussed this. We broke that 61.8%, but that 4,200 represents strong resistance. But we are not, this is not the time, still don't have any type of a shorting signals at this time. We are above our 8, 21, and 50 day moving averages, so that's still positive. But we were really a little bit overheated. We corrected, we went back to that 8-day exponential moving average and bounced back on Thursday. And then Friday, again, the shortened Friday after the employment numbers, we did go up. So we are still above that 61.8%. And then when we look at from the Bollinger Bands points of view, as you can see, we did go outside that, and then we came inside, and we've been just flattening. And moving averages are 18 and 100. They're basically flattening, but they are kissing each other, and we are above that. We are embedded, so that's still positive. So we want to keep that in mind. As far as the MACD, the trend is still up. So what I can see is this is kind of a wait and see. And again, we have that CPI and PPI coming up. But as far as this is concerned, just from this chart, is not, you can lighten up a little bit, but it's not a shorting time. I don't see any signals yet. The same thing when it comes to NASDAQ. NASDAQ is flattening, but we are above our 18. We are above the 100. The only thing is at the NASDAQ, we did just get to the overbought. So on the stochastics, and MACD is getting a little bit heated, and it hasn't crossed, but that's looking like it wants to cross, but it hasn't. It could kiss it and come back. The same thing with when we look at the stochastics, we have to watch Sunday night to see if that's going to bounce. But basically, it is just giving us a little warning. So it's a good time to take a little bit of profits based on, again, with stochastic being on overbought. But there is no shorting on this either. One thing I want to look at the Fibonacci on a weekly basis for NASDAQ, going back to the low of the COVID March 22nd, I believe, or 23rd, or sometime around then, that week of, and third week of March, all the way we go to the October and November highs. And then basically I looked at that, and then from the high of the 2021 to the low of October of 2022. So we have two different Fibonacci analysis. And where I pay attention is, where are the clusters points? So when we see, for instance, these two, and you can see clearly that 61.8 on the short is like sitting on 23.8 on the long term, the same thing as both 38.2% creates an important area for, in this situation, is almost like a resistance area, or could be a support. At this time, it is resistance, and we are right floating around that area. It's like 13,145 and 13,204, and we are at 13,184. So you can see that's a cluster, and then we go to that 50 and 23.8. That area is a cluster. So pay attention to these things. So there are, the more cluster we have, and you can do it even more shorter term, and that means the stronger either the resistance or the support. So this is NASDAQ, and basically you can see that area is important, again, that 38.2. And we'll see, would it be rejected, and would we go down, or can we break it and go at least to the 50% retracement, and somewhere around 14,000. As far as the Russell has been the weakest, and we had a little bounce last week, but then we have gone back. We see how the Bollinger Bands is now narrowing, and the volatility has down. And then last week I mentioned we were overbought, and you can see we got rejected, and that's why the momentum went down. The MACD is pretty flat. We are under 100. We are just floating around 18-day moving average. And again, you can see how the volatility has really died down. So again, pay attention to the CPI numbers. The same thing is happening with the Dow. Dow was strong last week, the previous week, and then last week was up a little bit, but we are really struggling around that 100-day moving average. Although we are embedded, MACD still up. So we are last 5 candles, you can see right around that 100. So we shall see perhaps maybe Wednesday or Thursday if there's going to be any type of a confirmation either way, whether we go to that 18-day moving average, or would we break above this 100-day moving average. Of course, we have an earning from the UNH, United Healthcare. It's one of the most expensive. It is the most expensive, and it's price weighted index with with Dow Jones. So let's see if that's going to have any effects on that index. The transportation was giving us a nice lead last week and telling us there's a little strength coming. We tried to break above the 100, and then we got rejected. So basically, as you can see, we got overbought, and then now the momentum is down. We are sitting right on 18-day moving average. The Bollinger Bands are narrowing, again, because of type of the week that we had last week, but we are rejected at 100. So pay attention to that, because I really, being old-fashioned, I still believe, the transportation are important leading indicators. So let's watch that as far as how the economy is perceived as. Now, as far as the VIX, we see that we've broken under 18 and 100. 18 is trying to cross 100. We are embedded. But as I said last week, just because we are like at 18.4, that doesn't mean it's end of, this is the markets are all good to go. remember the average we've had, like anything about 12 or 13 was the average for many years. So anything above 15 was actually worrisome. So here we have gotten used to numbers around 20 and above that, but still 18 doesn't give us the comfort. We are right on the support. So that doesn't tell us that we are out of woods as far as the markets are concerned. And the same thing, the VVIX, we did have really big volatility move, as you can see. And of course, we had the concerns about the banking problems. And right now, we are right on the 100-day moving average, although we are embedded in stochastics. Now, this is what it's been really the whole point of what is happening with the interest rates has been the leading light as far as giving the markets, especially the NASDAQ, the strength. And the yields right now, we are at 3.29, for instance. That's been, I mean, we've had such a volatility in those, and we are actually 3.288 to 3.29. We are outside the Bollinger Band. It's just coming in. We are oversold, and MACD is down. So one thing I want to pay attention is the CCI, and you can see the CCI, we see a divergence. We see that actually it's hooked going up, and so the volatility is slowing down. But what is happening, is this a chance that maybe we have hit the bottom in the 10-year yield at this time? Is it too far down, and will the markets try to at least a little correction, in the sense that means that, which is not good for consumers, the yield could go up. Maybe we did overdo it, although we are under the 18, we are under the 100, we have crossed the 100, 18 has it, but maybe in short term we could bounce back again. We are oversold, and we do have divergence with the CCI. I want to look at again, going back on a weekly, on the Fibonacci, going back again to March of 2020, the highs that we just saw a few months ago in October. And we can see that, again, I want to use the clusters. So I use the low of the summer of last year to the high of October. And then you see, again, we have cluster at 50%. And the 23.8, that's about 3.4%. We have broken that, gone below that. We are in an ambush zone in a short term. So does that mean, again, we can look at the support and resistance in that area? Or would we have a little bounce back from our ambush zone and go back to 3.4, 3.5? And then the next one could be about 3.65. So these are the things you can use it as a reference, but we might be a little overheated in the low as far as interest rates. And we actually I want to look at the 5-year, and you can see we did go hit the upper Bollinger Band. And again, there's a divergence from the stochastics, and we got rejected. So the 5-year is going to, usually what happens, it goes to that 18-day moving average. So the same thing, again, you see the divergence in CCI. MACD still, the trend is still up, and momentum is slowing down. So let's see what happens. But it looks like we are overheated in notes and bonds. And this is after, again, what happened on Friday with the numbers. The numbers were actually, again, they were healthy. And again, and employment numbers down. So the market thinks, at least the reaction from the bond market up to this NFP numbers, they were thinking that there is a good chance, and we will talk about that. We will see as far as the May 3rd meeting, that there's a good chance Fed is going to pause rather than even increasing the 0.25%. But I think the odds have changed, so there is anticipation that we would see, rather than the 4.75 to 5. That would be something that we will see that 0.25% increase to the 5. So basically, you see there's a we were overbought in the stochastics, and I go to 30-year bonds, you see that the same thing. We are overbought, and we went to Bollinger Band and got rejected. The same thing with the CCI. There is a divergence. So pay attention to that as far as the bonds go. The next thing I want to really pay attention, and I think that's very important for actually from a longer term point of view, is what is the dollar doing? And the dollar, we looked at the long term, we looked at that 100, 101, and it has been, for good reasons, because of the lower rates, obviously. And again, we look at the interest rate parity, what is happening with the euro. You know, they still have more rate hikes to come. And although, by the way, Germany's chances are pretty good that they might not even go to, they don't believe they are going to have recession. So they look stronger than other economies. But as a whole, euro looks like that they are looking more attractive than the dollar, especially if there is an end of the cycle for the increasing interest rates. On top of that, what we have is, again, is there going to be another shoe dropping in the banking? Now, with what happened with the UBS and Credit Suisse, with the Bank of Switzerland coming in, rescuing, and United States, the Treasury, and, you know, the big interference, Fed, you know, we had the two banks, and then the Republic Bank, they all kind of looks like, oh, it is resolved. But I don't know if the markets believe that. And I think the dollar is telling us that. So what the reaction will be if the dollar doesn't get the strength? I mean, we are basing right now, so we are actually still embedded, getting close to oversold, but MACD is down, and we are pretty much depressed, but that 100 plays a big role. We had 101.73. Obviously, that's one of the reasons gold has been strong, and that has been the really the safety net in some ways, and but also it obviously it helps the commodities, and especially again gold and silver. And on top of that, it will help the emerging markets too with the lower dollar. So for next months and years, I would pay attention to this area that we are in, about 100. So let's watch that. And then we see the reverse on euro. Euro has broken above its 18 and 100-day moving average. We are embedded on the stochastics. The MACD is still up, although we are CCI was a little overheated. We are momentum is shifting downward, but we are close to that 18-day moving average. So we'll see if we find a support there and whether we bounce. So these are important times. And again, both markets are looking at their central banks for answers. And obviously, again, we look at that CPI number coming up, and the PPI after that. And you can see how gold has done opposite of what dollar has done. We are still above that 18-day moving average. Remember that the 2000 area, actually 2009 was an important number. We cracked at it. We did break above that, and with the strong job numbers, that doesn't help. Obviously, when the rates go up, it's not good for the gold. But because of the stability, thinking that we are at the end of the cycle, so gold has been behaving well. We are overbought, and so pay attention to that. Although MACD is up, so we are hitting the Bollinger Band, the upper side, but we are above, comfortably above the 18 and 100. So we might have the retracement, but gold is not something I will short. So you can take some profit. I have been taking a little bit of profits as when we hit those Bollinger Bands, but still it's in pretty good shape. Silver actually been stronger than gold, but that's getting a little overheated. we're hitting that Bollinger Band, but it is embedded. MACD is nicely up there. Even CCI is up there, strong, although it is pointing down. But we might be a little overbought, but that doesn't mean, again, shorting it. I will take a little bit of profit. We are hitting the volatility band, the Bollinger Band. So, and Bitcoin is another story from again, with the banking crisis, what has happened, it has become actually a risk on, but also in a way of a safety net with all the bad news. The thing I want to pay attention, though, we've been really flat for the last 2 or 3 weeks. So you can see now we are in an overbought. The momentum is going down. We were embedded for a while, but this week we finally got overbought, and now the momentum is down. MACD is crossing, so be careful. We are right on the 18-day moving average. If we don't hold it, we will go to the lower edge of the Bollinger Band, but the Bollinger Band is narrowing, so the volatility is dying down. But if you recall, when we go back to February, and before that, we were talking about this, the whole December. We mentioned December. Look at this, again, the contraction. Look at we call it the snake. It was coiling and coiling, and finally, you see when it broke up, it was a big move. So that's why we pay attention to these. Right now, the Bollinger Bands are not narrowing, so we are going to that contraction zone. So let's pay attention to that. And as you can see, the 100-day moving average held very nicely that support. So, and once we broke above the 18, we've been above that. So now it's a crucial time. So let's pay attention to that too. And crude oil. Now, crude oil, I think a couple of weeks ago, I said we were at about 68 or so. And I mentioned I wished, the government would buy the strategic reserve. They could fill it out at between, I think, about 68 or actually it was like maybe 63 or 64, somewhere, or I think it was about 68 or on somewhere around that. And now we are back above $80. So, and what was the news? Well, we will discuss that. It was about OPEC, but the charts were telling us too that we were really oversold and that Bollinger Band could hold. And we did go back to 18-day moving average, and we broke above that. So now we are embedded, and MACD has crossed. So you see there's a combination of buy signals for us. And now, last week, after the OPEC news came Sunday night or Monday morning, our time, their Monday decision, we will discuss that, that we broke above that 100-day moving average. Now, the question is, do we have strength to go up? And we will discuss it actually in our lesson of the week. Expected move, it was really nothing. I rather than the S&P cash, I used the futures because we had a Friday morning, and you see we are right in the middle of the whole band. As a matter of fact, you see that we will have about $66 width for this coming as for S&P, as far as if you want to put your numbers in. NASDAQ, we went right to the lower edge. Look at what happened. We just bounced back. As far as Russell, that one we went outside on Wednesday, and then we bounced back on Friday. Then Dow was right smack in the middle. And as far as the 10-year notes, we did go outside, and what happened Friday? We came inside. The same thing with gold. We were outside and we parked right on the upper edge. We did hit our high of 2049 on gold, and silver actually stayed outside. It was stronger than, again, gold. It stayed outside its upper edge, and the dollar went down to its lower edge and bounced back. So really respecting our these boundaries. the same thing again. This was very uneventful. So financials right in the middle, which I think that's gonna be a big story in the next few weeks. Want to pay attention. And then energy was strength again. What happened with the OPEC? We went outside, jumped over, but where are we? We ending right smacked on the upper edge of the expected move. All right, a few things about emerging markets. This is as of Wednesday again, a lot of blue, and then we got slowed down. There was really hardly, except for Russia, which really doesn't mean much for Western and let's say US and Canadian investors. They were down, and then Pakistan was down, and Thailand was down, and then Israel was down. Israel has its own political problems right now. But as a whole, we still see that Europe is doing pretty well. The euro area is up 13.8% year to date. France is, for instance, 13.5%, and Germany is 12.1%, Italy is 14%. So they are doing pretty good. And of course, Turkey was a big winner last year. They're down 9.5%. South Korea is doing well, 10.9%, and Taiwan is up 12.2%. And surprisingly, again, Argentina, they just got an IMF got accept for the more loans, so they are at 24.4%, and Mexico at 11.8%, and Egypt is at 16.4%. So I talked about the dollar, and I bring this up because we still see that the dollar and euro are almost 75% of the global reserve. So there has been a talk with the Chinese yuan and the talk between Russia and Brazil and Iran, and they all looking at alternative currencies. And but as of now, as you can see, US dollar represents 54.1% of the world reserve. Euro is at 19%. Japanese yen, which I will also follow that for the next, in the long term, I would like to, we want to pay attention to that. I mentioned last week is at 5.1. British pound is at 4.6. So when you think about Chinese renminbi or yuan, is only 2.5%, which is just barely higher than Canadian dollar and Australian dollar. So this talk, dollar is still important to pay attention. A lot of countries, especially in emerging markets, their reserves is in dollars. So right now, there is something maybe in 10 years or so, they are working, but that's what I think is still important to pay attention what the dollar does. Let's go back to the crude oil. And, as I mentioned, I think last week I said, watch for Monday news for OPEC. Well, the OPEC came and they decided that because of, again, the prices had gone down, and they're not gonna, as far as output, they're gonna be worrying about the global growth, so they're gonna cut the supply. So, and that's something that basically pushed the prices up. And one of the things I think we have to pay attention is, I've said it, I think I've had the $80 a comfort zone for these countries. That's where their budget works the best. So whenever we go to under like $70, there's always some kind of a gamesmanship going on. So please pay attention to that. The excuse is perhaps that they want to, well, they're not sure about the global demand. And another thing is, there was just news came out yesterday, I believe it was Russia said that they actually been cutting their supply. So basically that's, again, this is the OPEC, they're trying to take advantage of, again, the situation. So that's the reason we had the big jump on Monday. changing the subject to something that was a big move last year in 2022 and then repeated 2023, something called Inflation Reduction Act and IRA. It was approved, and it was a 10-year plan that includes investment in really climate protections, and they give tax credit for households to offset energy costs and reduce carbon emission, and funding to support clean energy production. It's a huge one, and also it's supposed to combat the inflation, and basically it was a huge amount of part of the budget. So what I thought, let's look at what is the impact of this U.S. Inflation Act on emerging markets. So to benefit from this IRA, again, this is U.S. this is called Inflation Reduction Act. A country needs a free trade or similar agreement with the United States. Now, a quarter of the 20 countries that have this, the FTA, are emerging markets, and these countries are Mexico, Chile, and South Korea. So if you're operating in a country without an FTA, implies that the companies exporting to the United States cannot benefit from the subsidies offered for the renewable energy or the electrification of transportation. This is particularly relevant for EMs that supplying raw materials for batteries. Now, Indonesia is the world's largest supplier of nickel, a critical input to the production of batteries. The country is receiving increasing foreign direct investment on hopes of an agreement similar to that of Japan, who recently signed with the US on critical materials for the batteries. So the commodity producers' recent and planned initial public offerings are deepening in Indonesian capital markets and raising the country's profile among the EM investors. So I just want to tell you, it's good to pay attention to some of these political acts in a sense, and that's where billions of dollars are invested. So pay attention to the companies that they are working in those countries, that they do have this free trade agreement, and Indonesia will be working on it. So as we're talking about lithium, but of course the nickel has become a huge component as well. So that's just a little lesson. Another thing I thought from the charts, looking at, again, with all this banking crisis, well, let's look at some of the top performing emerging market banks, and you will see some very commonality. The best rating when we look at the valuation, quality, growth, risk, profitability, and momentum, and you look at the whole thing, the number one bank is Al Rajhi in Saudi Arabia with the $75 billion market cap. Valuation is pretty rich, so it's not the top, but the quality obviously plays a big role. And the profitability, obviously, it's there. But the second bank, and this one we can use most of these don't have ADRs, but the Banco do Brazil, we can look at that, and it's a second best, or they're three tied for the second. So we have Banco do Brazil from Brazil. Speaking of Indonesia, is the BBCA. Their market cap is at almost over $68 billion. The valuation is not very good, but their quality and profitability and risk is pretty good. So we want to pay attention to that. Again, it's tied for second, which is number 4, is QNB. They're from Qatar, $40 billion market cap. Then we have the FAB, and as far as this is United Arab Emirates. So AE is Arab Emirates, and they're $39 billion. And then we have KFH from Kuwait at 35.6. And the last one is the Standard Bank from South Africa. So you see almost every one of these are, 5 out of 7 are from Middle East. And the other one is the Brazil from South America. And then we have South Africa. A majority of these are commodity oriented and natural resources. So is again diversification in their investments, but also again very much involved with commodities. So anyway, so just a food for thought. And the last one, well, it's not the last one, but I emphasize a lot about fintech. I just talked about the dollar. Well, with this banking crisis, you can see the importance of the fintech. So I thought, look at the top ranked countries as far as fintech from the financial point of view. Number one is Malaysia, Hungary, Poland, Saudi Arabia, United Arab Emirates, as far as just some of the strength and their weaknesses. But those are the top 5 in emerging markets. The last one is more of a trivia in a sense. I just want to have a little fun fact here for you, talking about emerging markets. I thought, well, let's think about what is the most spoken languages in the world, and so how many of them are actually native and how many of them are non-native. And of course, English is the #1 language with about 1.5 billion, 1.452 billion people, but over 1 billion of them are non-native. So they speak in the countries that it's not the really first language in some ways. And of course, talking about native, Mandarin is 928 million people. There's natives who speak Mandarin. And then there's a Hindi, Spanish. Then we have French, Arabic, Bengali, Russian, Portuguese, Urdu, Indonesian, and then German, Japanese, and Nigerian. So just a lot of African, not Telugu, Marathi, Turkish, Tamil, and EU Chinese and Vietnamese. So anyway, a little fun fact. All right, so let's go to a few lessons of the week. I just wanted to look at the long-term charts from 1900 is the Dow inflation adjusted. This is inflation adjusted, which is more important than the non-adjusted. And that's looking at this long trend from 1900. As you can see, we have really surpassed the upper edge and we came back. This is a monthly again. And then we have our 14-year shorter term, and then we came down and bounced back. So there are some crucial points. We're heading towards really long-term 120-year trends on the upper edge. So at NASDAQ strength, going back to end of March, I just want to share with you the best week as far as weekday. Looks like Thursdays are the strongest and Fridays are the weakest for trading NASDAQ. Also was looking at NASDAQ, it's on a long term from 2000, of course, we had the bubble. Relative to Russell, you can see Russell really, especially we had a lot of value. Remember, we had the energy, the financials, part of the Russell 2000, and Russell really did much better on the relative strength. As you can see, NASDAQ just got killed till middle of 2002. After that, till you see it till 2009, it was like a give and take. And after that, then in about 2011, and then another stage in 2014, NASDAQ really overtook a lot of growth. Remember, this is NASDAQ 100, the FANG stocks. And now you see this huge volatility. All of a sudden, when we go back to 2000, beginning of the 23, you see the 2022, NASDAQ was the biggest really loser as far as our indices. And now they've had a big move against the Russell. So this was just looking at the historical. You see this huge volatility now since 2020. So this also was interesting as far as looking at the history. We just finished our first quarter and we finished at 7%. So this study was done, what S&P does after the first quarter, we are at 7% or better. And it has been 100% that we are up. Some of the years in 1954, we finished up 45% for the year. Then there are times that in 1971, for instance, we were at 9% and we finished at 10.8. We had another occasion in 1986, we were at 13.1 the first quarter, but we only made another 1.5%. We finished at 14.6. In 1987, if you recall, we had a strong at the 20.5, but we ended up at 2. Remember, we had that our famous October 19, 1998, 1987. So what we have to look at in 2012 also, we had 12%, 13.4. So is this going to be a year like 1987, which we finished the year in green, but does that mean that we could have losses from now on, or is it going to be like most of the other years that we could have more growth? Of course, it's been a long time since we had any type of like environment that we are in. But if the history tells us the average year after the first quarter up 7% has been 23.1. So it's always been in the green. So that's one statistics I just want to share. As you know, I like the history. Another statistic is market corrections during midterm election years. So if you recall the beginning of last year, we talked about that there's a good chance it will be a negative year because it's the second year with the midterm elections. So what this tells us, what happens if there was a correction at the midterm elections. So the last one we had was in 2018. We dropped 20%, and then the following year we were up 37%. So what happens every time that S&P 500 had a 20% plus decline or more in midterm election year, 1 year later the markets rallied 30% or more. So this is the rally. It's not the end of it's just from the bottom, the rally is 37%. So as you know, we had a 22% correction or in 2022. So according to this statistics, it should be a positive year. According to the third year of presidency, it should be a positive year. So these are just from the seasonality and statistical point of view. So just want to share with you that. Switching gears as far as the banking goes, and that's why I'm interested to see what the banks are going to tell us. It looks like the markets are telling us, it feels like all the crisis is almost over. But according to JP Morgan's survey, they talked to their clients, and they believe that the commercial real estate is the big cause of the next market crisis, specifically because a lot of small or regional banks are holders of these commercial real estate loans. So, and a lot of these loans, by the way, you have to be wary of that. They're coming due in next year and a half. Just be aware of that how much of them they're going to be coming due and they have to be renewed. So if you have empty offices, no income coming, and then you have to renew these, again, your loans, what's going to happen? Already you see the banks have already been tightening their credit. So which doesn't bode well for the economy in that sense. So as you can see, beyond the banking crisis, what do you believe is the likely cause of next market crisis? 14% geopolitical. US debt ceiling is 20%, that's coming shortly too. The hawkish central bank pivot, not much, but the commercial real estate is 35%. So that's after the US debt ceiling is the is 15% or higher than US debt ceiling. Talking about slowdown in economy, we want to look at the 2-year versus 3-month US Treasury yield spread. They're going back to 1977. Look, we are back where we were in 1980s, and then it happened once we touched the negative 100 or basis point in 2001, and this has only been more negative another in 40 years. it was in 2001, the Fed announced a surprise 50 base rate cut the next day. So when we've had this big, obviously spread, it says there was a rate cut. So that was in 2001, among other things. Again, at that time, we did not have inflation problems. So that's might be the difference. We're at negative 102 right now. We've had negative 104 in 2001. So I talked to you about the Fed meeting and what this NFP means. And this is from the CME Fed projections. This is for May 3rd meeting. So 28.8%, they believe that the Fed is going to pause and there's not going to be any increase in rates, which is going to stay at 4.75 to 5. 1.2%, they believe there will be a 0.25% increase at 5% to 5.25. The reason I want to show you, the day before the NFP numbers came, there was actually, the thought was there would be about 50%, 51% that the Fed is going to pause. A week before that, it was 51.6. So what it was, they were, they're still thinking about the banking crisis and they think that the Fed is going to take care of that. But that's what all of a sudden that NFP numbers, and let's see what happens with the CPI numbers, what will happen. On the other hand, that 0.25% was priced at under 50%. Was projection on Thursday. On Friday, went to 71.2. I want to go to the next, and just looking at, I skipped June 23rd, just going to July 23rd. The projection is actually that we will be, by then, only 0.25% will be up between now and July. As a matter of fact, there is going to be a rate cut, and there's a 14%. And you can see again, before that, when we looked at the rate cut, the day before the NFP, there was 36.6% saying that, yes, there will be a 0.25% actual rate cut from where we are now. And now it's down to 14%. So these data, and as you know, the Fed is very much data driven. So one problem I have at the Fed is, all of these are in the past. I mean, we look at the employment number, it is where it was. It's not like where we are going. So that's why I like those leading indicators. So unfortunately, the Fed constantly is playing catch up. So just a food for thought. But this is, I thought, it's a good way of looking at what the market is thinking. Again, this is a little a fun fact. This is a reference. We talk about money all the time, and investments. I just want to share this with you. The most expensive neighborhoods in every state, for instance, in California, is Beverly Hills, and at $22.77 million as far as the real estate. So anyway, that's just a little tidbit. Shortly, just didn't have a specific trade. It was very slow market, no gold trade last week. And this is our gap plays, and I use that in 5 minutes. This is 15-minute gaps. What you can see, though, when we go back to last week, we do have two. When we have this gap, when we have a gap up, it's already filled. So this gap hasn't been filled, and this gap was almost filled, but this gap is not filled either. So just a food for thought. Usually, it's supposed to be done about 10 days. As the time goes by, it just gets a little more difficult. I like to see it within 5 days, but you've seen it in the past that within 2 weeks, even it gets filled. So just have these points, and as a reference, just have it handy to just look at. As I mentioned, Friday was our NFP, and again, this huge move, not much volume, but look at this. And of course, we stayed within the range. So I would ask your attention to look at these zones and as a reference, as pivot points, perhaps for support and resistance. And I want to pay attention to the 10-year note. Look at the huge move that what happens with the 10-year, and that's what the rates actually did go up. And we just ended the day right on the support, the low of where this is on 5-minute candle. You see, we finished right on the low of that first 5 minutes. Okay, this is just a reference. Quickly, ETF of the week, the gold miners, they were the performers last week, up 6.4%. And underperforming was a clean energy. They were down about 8.3%. Other good ones were the junior gold miners were up 4.7%. And again, clean energy index fund was down actually 8.1%. On ETF, I just want to pay attention to some of the commodities. Of course, don't do as much sugar. A long time ago, I used to do sugar and options and sugar futures. They're not very liquid. It's a little difficult to play them. And that's what options actually sometimes are pretty good. But look at this big move from the low of what we had during the COVID. And we've had a really nice run. This almost looks like a cup handle, and we broke above that. Now we're getting to a major resistance, but there's a lot of room to go if we break this. So what is happening with sugar? India being the #1 really producer, it is there's a lot of supply problems there. So we have really issues there. So we've had this big run in last few months, actually. So the question is, if you want to play this, I think we might have mentioned it. Well, we've had a class on these soft commodities, so I would encourage you to watch that. But if you want to play sugar, there's 2 ETFs you could use. One is the SGG, but as you can see, the average volume, the average volume is pretty low. It's 4,000. This is a weekly volume. And so it is not a very liquid, but it has done well. As you can see this week, this year so far, it's up about 28%. For the for half a year is up 43%. It is optionable, but it's not shortable. A better option, and also, by the way, it is an ETN, so it is exchange traded notes. So it's not the fund, it's actually uses the notes. There is Tellurian, which they do corn, they do wheat, they do soybeans. They're very much into agriculture. And it's cane, and cane is much more liquid, and average volume is like 85,000. It is shortable and it is optionable, so it's a food for thought. You can basically maybe use this, and this is the chart. They're also up about 28%. So that's just if you want to follow it, something completely different than the stocks. Just to compare them, you can see that the expense ratio for the Curium is almost 2.5 times what it is for SGG. Just a food for thought. Assets under management, SGG is higher, but average daily volume, you can see that cane is a better choice in that sense. So got to value all both, but the liquidity, obviously playing options, might play better with cane. Stock of the week. This week I thought, although it's stock of the week, but it is actually an ETF, which is the HYG, which is the really high yield bonds and really kind of junk bonds. And we watched, I think I've mentioned a couple of times before, I watched this as a guidelines as far as is it risk on, risk off. So this is a picture of all my my Ichimokus, as you can see, from daily, weekly, monthly to 10-minute, 30-minute, and 60-minute. You see, we broke out nicely, and then when you have this flat line on a cloud, that presents a resistance that we want to stay above. It's a much better than when there is the curvatures, and we could not. So we are down. We bounced off our trending line and back to that resistance. So the question you have to ask is, on a weekly basis, we're against the cloud. On a monthly basis, we are right on the trending line. And on 60 minutes, it just came down. So that's from the, as far as a charting point of view, as far as the technical side of things, what is this a good place, and how would lead us as far as the stock market goes? This is a chart on a daily basis. And as you can see, first of all, it is very liquid. Average volume is 49.50 million. And it is right in the middle of almost building this wedge here. We are right above, as you can see, we are above the 20-day moving average, flat on 50 and 200. So it's really neutral. We are right in the middle of, smack in the middle. But from the fundamental point of view, this is the question you have to ask. If I'm investing in a high yield corporate bonds and I'm getting 5.49%, and the Fed rate is at 4.75 to 5, let's say 4.75, or I can go buy 3-month T-bill. Is it worth to pay 0.50 basis to 100 basis point to own this? So there's something is not registering. So from fundamental point of view is, why do I want to own in a very uncertain environment to get 5.49%? I mean, year to date, this is up only 1.64%. So basically, majority of your yield is really coming from the dividends. It's not the price appreciation. You see, this is where we were and this is where we are. So anyway, just so this week, it's what my suggestion is. I'm going against the grain. I usually suggest buying, but this week I thought to look at sometime to be diversified, maybe start looking at either shorting or buying puts, or that mentality to diversify. Talking about that, another thing caught my eye was the GE. I looked at the linear regression channel on a monthly basis. We are right on the top of our 2 standard deviation on a monthly LRC. It has done very well. I mean, it takes a lot. You can see there's a lot of digestion when it hits the lower edge. I mean, this is a beautiful move. As you can see, it's 100% move, and it has done magnificently. But the question is, are we overheated? It's just the monthly is giving you a heads up. That doesn't mean you have to jump in right now, but you should watch weekly and monthly on this to see when might be a good idea to look at some puts in a few months from now. But again, this is not really a short term. It's not like a swing trade. It's not for a week, but it's a thought. So, and again, this is from the technical point of view, and you can see how beautifully it has been an up channel. We are, we've been hitting the top of the channel, and we just got last 3 days got rejected. Of course, we didn't open on Friday, but we are above the just above the 20-day, 50-day, and 40% above the 200-day moving average. So you're way up there. The question we have to ask is, this is industrial machinery. It's a cyclical. What happens with the economy and other things? How would that affect them? So I'm looking at fundamental, and then I just want to use the chart. So today's suggestion is maybe you should look at some alternatives rather than just buying, maybe looking at some shorting the markets, or I mean, in a put way. I mean, I don't want to go up and short it if you don't have to. As you can see, the target price was 96.78 and we hit 97, which doesn't mean a lot. These are the analysts coming up with their projections, for instance. But anyway, I mean, it's up 43% year to date. So just food for thought. Anyway, we are almost at the end. So for the squeeze of the our squeeze candidates, I looked at I find international holdings might be a good ones. So these are all the ADRs. I'm looking at the market cap. So I sorted them by market cap. So that's just some candidates for you for a squeeze. As I mentioned, earnings are starting. Monday we have Tilray, which used to be a very interesting story a couple of years ago with the cannabis, and we have CarMax. I will be interested to see what they have to say, and Albertson will be interesting. But the main ones come on Thursday, but major ones will come on Friday. We have Delta Airline. I will pay attention to that. Infosys, Indian company, technology, pay attention. But look at this. We have JP Morgan, United Healthcare, I mentioned, Citi and Wells Fargo, and BlackRock and PNC. So that Friday morning is crucial. So be prepared, this weekend if you want to have plays. But if not, at least keep in mind the analysis of the projections of these banks. As you can see from the volatility point of view, Tilray is there. It's always been pretty volatile. CarMax and Delta Airline for a lesser degree. So these are their volatilities, don't have a lot of earnings coming. And these are some of the from our earning whispers. I think whispers are more important than just the earnings outlook. And these are the projections about JPM. I just chose the main ones: United Healthcare, Citi Group, Wells Fargo, CarMax, and Tilray, and Delta Airline. So with that in mind, I hope it was helpful. I wish you a wonderful week ahead. And I'm going to go ahead and start recording, and we can open up for